Every year, millions of Americans walk through the giant metal doors of Costco, bypass the thousands of discounted wholesale items, and make a direct beeline for the food court. They line up for one very specific, almost legendary item, a massive quarter-pound hot dog paired with a 20-ounce soda. The price? Exactly $1.50. That price hasn't changed since 1985. Think about that for a second. In 1985, a gallon of gas cost about 90 cents. A movie ticket was less than $4, and the average home set you back around $80,000. Today, everything costs significantly more, yet Costco's hot dog combo remains stubbornly, miraculously stuck at $1.50. If the price had simply tracked normal US inflation over the last 4 decades, that same hot dog and soda combo would cost well over $4 today. So how does a publicly traded corporation, responsible to Wall Street shareholders who demand relentless quarterly profit growth, lose an estimated $40 million a year on a cheap lunch item? The short answer is, they don't lose money on it at all. In fact, that cheap hot dog might just be one of the most brilliant financial growth engines in modern retail history. To understand why, you have to look at how Costco actually makes money, because it operates completely differently from almost every other major retailer in America. If you look at a traditional grocery store or major retailer like Walmart or Target, their primary business model is selling physical goods at a markup. They buy a box of cereal or a set of bed sheets at wholesale price, market it up anywhere from 20 to 50%, and pocket the margin to cover their store overhead and generate profit. Costco flips this model on its head. Instead of relying on product markups for their bottom line, Costco is essentially a subscription business disguised as a warehouse store. Over 70% of Costco's total annual operating profit doesn't come from selling flat-screen TVs, bulk toilet paper, or rotisserie chickens. It comes entirely from membership fees. Millions of households pay $60 to $120 every single year just for the privilege of walking through the door and shopping there. Once you pay that annual fee, Costco's main goal changes. They no longer need to maximize the profit margin on every individual item you put in your cart. Instead, their ultimate goal is retention. They need to keep you coming back year after year so you never think about canceling that membership. This is where the hot dog enters the financial equation as what economists call a loss leader. A loss leader is a product sold at a financial loss or at zero profit margin, specifically designed to attract customers and drive overall revenue somewhere else in the business. But calling the $1.50 hot dog a simple loss leader actually underestimates its psychological power. It's an emotional anchor. When you walk into a store and buy a massive bulk box of paper towels, a pair of jeans, and 3 months' worth of olive oil, your brain registers a large financial transaction. You just spent $200 or $300 in 20 minutes, but right before you walk out the door, you stop at the food court and buy lunch for $1.50. That final interaction leaves a powerful psychological imprint. It sends a subconscious message to your brain that Costco is a place of incredible, unbeatable value. You leave the building feeling like you won. That positive sentiment completely reframes the entire spending experience. It reinforces the belief that your membership fee is worth every penny, ensuring you renew it again next year without hesitation. In addition to driving emotional retention, the food court acts as a physical foot traffic magnet. Retailers pay millions of dollars on targeted digital advertising, mailers, and television spots just to get shoppers inside their doors. Costco doesn't spend virtually anything on traditional advertising. Instead, the cheap hot dog and the legendary $5 rotisserie chicken do the marketing for them. Once a customer is physically inside the warehouse to grab a quick, cheap lunch, the probability of them walking out without picking up a few extra items is virtually zero. They walk in for a $1.50 hot dog and walk out having spent $95 on items they didn't even know they needed. In retail terms, the customer acquisition cost is practically zero, while the immediate shopping basket value goes through the roof. Now, you might be wondering, if food prices keep rising, how can Costco keep this deal financially viable without letting the losses spin completely out of control? The secret lies in radical vertical integration and relentless supply chain control. Years ago, Costco was buying their hot dogs from external manufacturers like Hebrew National, but as meat production costs rose, supplier prices went up, making the $1.50 price tag increasingly painful to maintain. Rather than raising the retail price on the menu board, Costco made a radical move. They bought the entire supply chain.
They built their own massive meat processing plants in California and Illinois. By owning the facilities, controlling the sourcing of the beef, manufacturing the hot dogs themselves, and managing the distribution directly to their stores, they eliminated the middleman's profit margin entirely. They chopped their production costs by more than half, allowing them to keep the food court price completely frozen while insulating themselves from external supply shocks. They did the exact same thing with their famous rotisserie chickens, building their own massive poultry processing ecosystem in Nebraska to protect the $5 price tag. Whenever an executive suggests tweaking the menu price, the response from leadership has historically been swift and uncompromising. There's a famous piece of corporate law involving Costco's co-founder, Jim Sinegal. When former CEO Craig Jelinek approached Sinegal complaining that they were losing money on the hot dog combo and needed to raise the price, Sinegal famously looked at him and said, "If you raise the effing hot dog, I will kill you. Figure it out." They did figure it out, and by figuring it out, they turned a basic food item into a legendary brand asset that money literally cannot buy. When you break down the financial reality, Costco isn't sacrificing $40 million a year out of corporate charity or nostalgia. They do it because that loss is an investment in consumer trust. In an era where consumers are hyper-aware of shrinkflation, hidden fees, and skyrocketing prices everywhere they turn, Costco's unwavering commitment to the $1.50 hot dog stands as an untouchable monument of price stability. It's a masterclass in long-term financial strategy over short-term corporate greed. While other companies sacrifice brand loyalty for quick quarterly margin bumps, Costco uses a simple quarter-pound hot dog to build an ironclad contract with over 100 million global members. So the next time you stand in line at the warehouse food court holding a $1.50 combo, remember, you aren't just eating a cheap lunch. You're participating in one of the most calculated, counterintuitive, and wildly successful business models in modern economic history. If you found this breakdown interesting and want to understand the hidden financial mechanics behind the everyday businesses around you, hit the subscribe button and turn on notifications. Thanks for watching, and I'll see you in the next one.